All right, let's put on our sell-side equity analyst hats today. We're going to rigorously investigate one of the most extreme market anomalies out there right now, applied optoelectronics. If you spend any time at all looking at market data, you know that occasionally a stock comes along that just completely defies traditional financial gravity. And well, that's exactly what we're looking at today with ticker symbol AAOI. Our goal as analysts is to build a documented fundamental valuation. So we're going to strictly rely on the source data, strip away all the market noise, and see what the core fundamentals actually tell us about its intrinsic value.
Here's our game plan to get there. First, we'll look at the AAOI market anomaly. Second, revenue versus negative earnings. Third, absolute valuation models. Fourth, relative multiples. Fifth, we'll dive into an asset-based valuation and margins. And finally, Section 6, the final analyst verdict.
Okay, kicking things off with Part 1, the AAOI market anomaly. Let's look at this massive disconnect.
Now that is a staggering number, literally over 1,100%. That is AAOI's trailing 12-month total return compound annual growth rate. To put that into perspective for a second, a really aggressive equity analyst might hope to model a 20 or maybe 30% growth rate for a strong tech performer. Over 1,100%? That's the kind of momentum that just completely breaks charts. It signals that the market is aggressively pricing in a massive, paradigm-shifting future for this company, and they are rewarding it with extreme speculative fervor.
And you can really see that wild ride right here, bouncing from a 52-week low of just over $12 a year ago to a peak of nearly $192. Even today, sitting at around $148, it commands an enterprise value and market cap soaring way past the $11 billion mark. It's a classic momentum play, for sure. But as analysts, our job is to ask the hard questions. What is the fundamental floor actually holding up this towering price tag?
Let's dig into that in Part 2, revenue versus negative earnings, the classic growth paradox.
So on one side of the equation, the bulls see this massive top-line revenue growth coming in at an incredibly robust 82.75% over the trailing 12 months, generating roughly $455.7 million in sales. I mean, that top-line expansion is exactly what growth investors want to see, right? But on the flip side, the bears see a company that is fundamentally losing money at the bottom line. The trailing 12-month net income is sitting at a negative $38.2 million. So the story here is they are selling more than ever, but those sales just aren't translating into actual profit.
Which brings us to Part 3, absolute valuation, and frankly, a massive cash flow problem.
This is honestly an equity analyst nightmare, just a sea of NAs. When we try to rigorously document a fair value using standard absolute models, we immediately hit a brick wall. Look at the DDM, the dividend discount model. We can't use it because their dividend yield is 0%. We can't do a sum of the parts valuation because the filings don't give us distinct positive cash flowing segment data to value independently. What about an adjusted present value or residual income model? Well, both are deeply impaired by the company's extreme negative return metrics. The core data required to build out a reliable model simply isn't there.
And then we hit this number, a massive negative $353.9 million. That is AAOI's trailing 12-month free cash flow. Just think about that for a second. More than $350 million in cash burn over the last year. This isn't just some slight operational loss. It's a profound hemorrhage of cash relative to their current operational scale.
And this hemorrhage completely breaks the standard discounted cash flow, or DCF model. Usually, to find intrinsic value, we derive unlevered free cash flows, forecast an explicit growth period, and discount it back using the weighted average cost of capital. But you can't logically forecast and discount future value when step 1 starts with a bleeding cash burn of over $350 million, which yields a negative 3% free cash flow yield. When your starting base is severely negative, any growth rate you apply just projects a larger crater unless you make huge, highly speculative assumptions about sudden margin reversals. Because of that, the source data correctly refuses to assign a fair value using a DCF. It simply outputs NA.
All right, Part 4. Since absolute models break down completely, let's pivot to relative valuation multiples.
Now, the documents don't provide a list of specific peer comparables, so to keep our analysis strictly tied to the data, we have to benchmark AAOI against its own historical averages, and wow, it shows a wildly stretched valuation. The price-to-sales ratio is sitting at 25.86, that is over 400% higher than its 5-year norm. Investors are literally paying $26 for every single dollar of revenue the company generates. The price-to-book ratio is at 15.22, up 216% historically. This tells us that even on a relative basis, the stock is trading at an absolutely unprecedented premium. The market is pricing in utter perfection.
And let this extreme negative multiple sink in for a moment. An EV to EBITDA ratio of negative 436.41. Typically, analysts look for an EV to EBITDA ratio of under 10 or 15 to find value. A negative 436 multiple is an anomaly of the highest order. It renders traditional EBITDA multiples totally useless, and it screams that the fundamental earnings power of the business right now is completely divorced from that $11 billion price tag the market has slapped on it.
So let's look under the hood in Part 5, Asset-Based Valuation and Margins. Is there a safety net here?
Well, looking at the margins, there is severe erosion at play. They make about 28 cents on the dollar producing their goods, but operating costs absolutely crush the bottom line, dragging it down to a negative 43.7% net margin. Now, to be fair, their gross profit margin is actually up about 34% compared to their 5-year average. That's a positive sign that their core product economics might actually be improving. But by the time you pay for R&D, administrative costs, and corporate overhead, all of that profit just vanishes.
Furthermore, every core fundamental return metric we look for as analysts is currently in the red. Return on invested capital sits at a negative 7.07%. Return on equity is negative 5.21%. What this essentially means is that for every dollar of capital management is deploying right now, they are destroying value rather than creating it. If you're a value investor, that's a giant red flag. If you're a growth investor, it's a structural issue you're just praying that future scale will fix.
However, when we evaluate this from an asset-based valuation perspective, looking at the balance sheet to see if there's an immediate liquidation or insolvency risk, they actually hold up okay. They have a respectable current ratio of 2.63. Their debt to equity is down almost 55% from its 5-year average, sitting at a very manageable 0.27. Plus, a quick ratio of 1.91 means they have enough highly liquid assets to cover their short-term obligations almost twice over. So despite the massive operational cash burn, the balance sheet isn't flashing an immediate bankruptcy warning. They have a runway. And honestly, that runway is exactly what a high-momentum growth story needs to survive.
Which brings us to Part 6. Time to bring it all together for the final analyst verdict.
The source data's literal refusal to calculate a fair value price really perfectly summarizes our whole investigation today. This is a highly speculative, momentum-driven valuation entirely divorced from traditional fundamentals. When all your core models, from your DCF to your DDM to your earnings multiples, yield not applicable or extreme negative values, you are no longer investing based on current mathematical reality. You are investing purely on the narrative of what this company might become in the distant future.
And that leaves us with this final thought to ponder. In a market anomaly this extreme, which side of the equation will ultimately prove correct? If you're a fundamental sell-side analyst, the current price of over $148 looks like a house of cards built on negative margins and cash burn. But if you're riding the momentum, the 1,100% return and improving gross margins suggest a turnaround story that the traditional models just aren't equipped to capture yet. It's a fascinating standoff between rigid valuation math and wild market sentiment. Thanks for joining me for this explainer, and remember, always keep your eyes on the data.